If you are a European investor buying ETFs, there's one common mistake most people make without realizing. It's not about picking the wrong index, and it's not about timing the market. It's a simple ETF choice that quietly changes how your money actually compounds. Two ETFs can track the same market, but lead to very different long-term results. And once you see it, you cannot unsee it. Most beginners assume that if the index is the same, the outcome must be the same. But in Europe, that assumption breaks down surprisingly fast. Small structural differences between ETFs can compound into large gaps over 10, 20 or 30 years, even when the market performs exactly as you expected. That's why two investors can invest in the same index at the same time and still end up with very different results. I'll show you exactly where the difference comes from and how to avoid making this mistake yourself. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every single year in Central Europe. And if you want to see more videos like this, hit that subscribe button. If you've ever felt confused comparing ETFs, I want you to know something upfront. That confusion is normal. Most beginners are taught one single rule: pick a good index and hold it. And that advice isn't wrong, it's just incomplete, especially for Europeans. In practice, brokers, ETF platforms, and comparison sites rarely explain the structural details that actually affect your outcome. They show you performance charts, fees, and maybe fund size. But the most important difference often isn't highlighted at all. On the surface, ETFs look identical. Same index name, same logo, same line on the chart. And if you are confused by this, it's not your fault. The industry doesn't explain it well. This mistake doesn't hurt in year 1, it hurts in year 10. Let's build this from solid ground. Imagine two ETFs that track both exactly the same index. Same companies, same weights, same exposure to the market. Let's have the S&P 500 as an example, because this is the most traded and actually most preferred ETF in Europe. And let's compare the iShares S&P 500 and the Vanguard S&P 500 ETFs. When the underlying index goes up, both ETFs go up. When it falls, both fall. You check the historical performance and the lines almost overlap. Google doesn't show you anything alarming. At this point, every instinct tells you these products are interchangeable. They are the same. And that assumption feels reasonable up to this point. Everything looks identical, and that's where the trap is. Because underneath the surface, one quiet decision changes everything. How dividends are handled. One ETF is distributing, the other is accumulating. You can ask, where does those dividends actually come from? They are coming from the 500 largest companies of America. From the 500 companies, roughly around 400 pay dividends regularly. Most tech companies do not pay dividends, or just minimal amounts such as Google. It only pays 21 cents every quarter, and one share is well above $250, so that is a tiny 0.3% per year. However, other companies such as Altria pay a bit over $1 per quarter, and one Altria share is around $65-ish, which means they have a dividend yield of around 6.5%. When these payments come in, the ETF decided if they get reinvested automatically or paid out to you. A distributing ETF takes the dividends paid by the underlying companies and sends them to you as cash. You see the money arrive in your account. An accumulating ETF takes those exact same dividends and reinvests them automatically inside the fund. You never see the cash. The index exposure is identical. The companies are identical. But the compounding engine is completely different. One lets compounding run quietly in the background, the other keeps interrupting it. For European investors, this difference matters more than people realize, for three main reasons. The first one is tax. In many European countries, dividends are taxed at the moment they paid out. Even if you plan to reinvest them, the tax bill often comes first. That means distributing ETF can create a recurring annual tax drag. An accumulating ETF, depending on the country and account structure, can often defer taxation until you sell it. That difference alone changes how much capital stays invested and compounding over time. The second reason is friction. With a distributing ETF, you receive cash, then you need to take some action. You wait until the dividend is paid, then you decide where to reinvest, when to reinvest, place a trade. In the real world, this rarely happens perfectly. Sometimes the money sits uninvested. Sometimes it's reinvested at a higher price. Sometimes it's forgotten altogether. An accumulating ETF removes that friction entirely. The reinvestment happens automatically, consistently, and without emotion. And the third reason is behavior. This is the one nobody likes to admit. Cash in your account feels free money, isn't it? Some of it gets spent, some of it goes forward, something else. Even disciplined investors leak a little bit over time. And those leaks don't matter much in early years, but over decades they compound in reverse. At first, the difference between these two ETFs feel almost irrelevant. In year one, the gap is really tiny. In year two, still small. This is why so many investors dismiss it. But compounding doesn't move in a straight line. It accelerates. Every year, the accumulating ETF reinvesting not just the original dividends, but the dividends on previous dividends. The distributing ETF keeps breaking that chain. This is why people look back after 15 years and say, I did everything right, so why the results are smaller than I originally expected? Now, it's important to be balanced here. Distributing ETFs are not bad at all. They are context dependent. What does it mean? They are situations where they make perfect sense. If you are close to retirement, for example, or you want predictable income and distributions, this can be useful. If you're already living off your portfolio, receiving cash flow can simplify your finances. And for some people, seeing money arrive regularly provides psychological comfort. A mistake isn't choosing distributing. The mistake is choosing it by default without understanding the trade-off. So how do you choose correctly? Keep it simple. If you are still in the wealth building phase of your life and you don't need income today, an accumulating ETF is usually the better choice. It keeps compounding efficiently, reduces friction, and often improves tax efficiency for Europeans. If you genuinely need income now, distributing ETF can make sense. And if you are unsure, default to accumulating. You don't need complex strategy. You need the right default settings. Now let's do a quick self-check. When your ETF pays dividend, do you always reinvest every single payout immediately? Do you pay tax on those distributions? Do you sometimes let the cash sit on your account? And are you investing for 10 years or more? If your answer is yes to any of these questions, this choice matters more than you actually think. The key takeaway is this. This isn't about predicting markets or picking winners. It's a structural decision, a quiet one, but over decades it compounds just as powerfully as market returns themselves. If you want calm, practical investing explanations made for Europeans, don't forget to subscribe. This channel is about avoiding quiet mistakes and letting time do the work. If you want to build long-term wealth without unnecessary friction, subscribe to the channel and don't forget to hit the like button that helps the YouTube algorithm. See you next time.